Good evening, everyone. Welcome you all to our Carnelian quarterly catch-up. Every quarter, and you all know, we host a call for all our investors, our partners, and all our potential investors, giving you updates or insights on the market, our updates on the portfolios, and what are the new trends we are seeing in the market, and how are we planning to capture new trends in our portfolios. So we'll have our founder, Mr. Vikas Khemani, to give you updates on the market and I'll hand over the call to Mr. Vikas Khemani.
Hi, thanks, Tanay. Uh, Good afternoon, everyone. Happy Navratri. It's always, good to. I always look forward for this call every quarter as I get to interact with all of you. I get to share some of the stuff at our end. I get to, learn a lot from your questions. So, thank you very much for joining us today. Uh, So, like usually, how we do every year, every quarter, we will give you a quick insights into our performance, how it has been, what did we do, what did we buy new, what did we exit, and it'll be like a quick one. And then we get to what we think from here. What are the what is our market outlook, and followed by this time around, we're also sharing what are the few new one or two trends we are seeing, our insight on it, and finally, we'll obviously open for questions like every time. Happy to take any questions. Feel free to put your question in the chat or ask directly as well. Um, so getting straight to, I think, portfolio updates. Basically there are three products or three categories we have divided into a multi-cap portfolio, where we have, as you know, that a couple of products. Carnelian Compounder Fund, what we started with in 2019 in the form of AIF and then PMS, that's there. And then Bharat Amritkal Fund, last year we launched one and two. That's also there, all are multi-cap, and India Amritkal is for the offshore investors. So actually, while it looks five products, but they are all more or less kind of similar. Just because of vintage, they look appear, and hence we try to club in this category. And if you see, in last 1 month also, last 3 months also, last 6 months, across time periods, we've had a good performance. We've beaten markets by a handsome margin. It ranges between on an average basis since inception almost 9%, but in last 6 months at around 11%. In 12 months, we've beaten markets by 8%. So I think it just kind of shows that across the time period we've been able to sort of beat the market. Since we are long only, that matters the most. In our shift strategy, which again we launched in 2020, and AI we launched 2022. Again, it's been a great outperformance over long years. Last 6 months, of course, last 12 months markets have been kind of flat, but in this period also, at least we have done a little bit better than index. But of course, nobody likes the flat market, but that's the nature of the market. But in 6 months, we have done quite well. We recovered well from the whatever that knock which we took in the first part of the correction, and stood out. Same way again, bespoke strategy has done very well, across time frames, which is again where we do customized portfolios. What does not give me so much happiness is our contrast portfolio strategy, which did very well. If I look at from an inception, it has done very well. But in last 12 months, 6 months, 3 months, 1 month, it has been not doing well as compared to market. And that's of course we don't like it. It's not a I mean, that nature of the strategy was, of course, contra. When we launched that strategy, we guided our investor that will generate in this 12 to 15% return. Of course, we had an exceptionally great period of returns in that, but that does not, still absolve us from, being happy about what has happened in last 12 months. So there we have a very significant underperformance, and we constantly worry about it, that how do we correct it back, and we are taking a lot of measures to see how we can recoup some of the underperformance we have had in last 12 months. Though if I were to look at most of our investors in that has come from beginning. So, still they are deeply in the money, still they are, we had stopped taking money into that strategy post 22. And so it's still deeply in the money and continues to do well. But yes, we don't like this recent underperformance. which has been a pain point for us. Other thing is resiliency during, how we saw last 20 September 24 when market peaked out, and from there, how have we done? So if you see again, other than the contrast strategy, which I spoke about, I think all our portfolio has generated good alpha over benchmark, from last peak to this till now. And September also as a portfolio, we are doing well, but I'm saying September is still, yet to get over. But, we have all our funds are up between 4 to 5%. But I mean, even if since we're talking till August, from there also we have had good sort of alpha across our portfolio. Other and the reason why we look at because your portfolio should look at the resiliency is very important in your portfolio. Quality of the portfolio is also determined by that. And other dimension we looked at was in March. March was when market kind of bottomed out. We had extreme Jan, Feb, March was a kind of quite negative period, and market kind of bottom from 4th March. From there, how we have kind of recovered back. So test of any portfolio is how it recovers from the bottom, right? Of course, market recovers, everybody will recover. But how are you doing? Are you doing better than sort of market or significantly better than market? And again, data shows you that our portfolios did recover far, and which again is testament to the quality of the portfolio, which we keep building from time to time. This chart, I'm sure, is familiar to many of you that how our portfolios are generally this faster, stronger, cheaper framework. We have worked on it that our portfolios earnings and revenue should grow faster than the benchmark. And that's the only way one can sort of outperform one of the way. And ROE should be better than the benchmark, stronger. Stronger should be on two counts, ROE and debt to equity ratio. So if you see our ROE is far better across our portfolios between 17 to 18%, whereas benchmark is about 14.5%, 14.8%. Our debt to equity ratio is 0 to zero point 0.1, whereas the benchmark's debt to equity is 0.6. So we are far more stronger in terms of ROE as well as the debt to equity ratio, and in terms of cheaper in terms of PEG ratio. That how are we sort of doing vis-a-vis the PEG ratio? And if you see again, our PEG ratio is lower than the benchmark. And finally, the beta. Beta is a benchmark of risk vis-a-vis the portfolio. How was your portfolio is sort of behaving vis-a-vis the benchmark movement? And again, anything higher than one is a basically more risky. Lower than one is a less risky. So across all time periods, our beta across the portfolio has remained 0.9. And we generally keep on monitoring this. It's not that in a quarter here and there it can go up and down, but generally we have been over last 6 years, fairly steady on this particular crisis. Now, a little bit talk about how portfolio positioning is there in our Amrit's few portfolios. Let me start with Amrit Kal. That's the product which we launched last year, and again, it's a flexi cap product over. And here the idea is very much similar to identify great companies, great quality management, and with a view to compound over a long period of time. That does not change. But here we classified opportunities broad 5 baskets and across market caps: manufacturing, banking, financial services, and services, consumption, and infrastructure. And if you see, our weight across all these 5 buckets is very decent. Manufacturing BFSI ends up being, the largest, of course, and consumption is about 15%, services is about 15%, infrastructure is about 10%. So it's a very decently balanced portfolio. And again, some of the major holding, while most of you will be aware, but I'm just putting it here so that you can just kind of have a look at it. But Aditya Birla Capital has been one of the very large holdings for quite some time. In earlier portfolio we bought at 100 rupees, but throughout every journey we've been buying, and as you could see that stock is up almost 3x in last 2.5 years. And when we bought, it was against most of the I mean, we were the only institutional holder, first institutional holder to buy it. Hardly or nobody kind of owned it. So, again, part of our magic basket. We own Laurus, we own Biocon. There was a recent entry, which we have had in our portfolio. Again, a very high conviction idea. That suggests we've entered with a fairly aggressive weight on that. Uh, so yeah, I'll talk about a little bit more entries, but these are some of the holdings, and we are quite happy with the quality of the portfolio we are right now holding. We think that it is very well positioned, and if I were to talk about a compounder PMS, again, multi-cap, very much similar to Amritkal, but this is more in the PMS format, hence I'm kind of chatting. Again, holdings, if you will see, pretty much you will find a little bit, quite bit of mirroring. But yeah, Aditya Birla is large holding, Loras is large holding. Loras, by the way, has happened because we bought there quite early on. And stock has almost become 3x from there. Hence, the weight has gone up significantly from where we bought. Amritkal, it came later. Hence, it was a higher price, but still from there also it has kind of done very well. And if you look at again, portfolio attributes continues to remain faster, stronger, cheaper. It's not very expensive on a peg basis. Debt to equity ratio is lower, beta is lower, Sharpe ratio is lower. So I think all fundamental things are very well in place for the multi-cap portfolio and compounder PMS as well. Shift strategy, again, this is largely focusing on manufacturing 70 to 75% and 20-25% technology. That has been our uh, you know uh, mandate in this strategy, and we continue to sort of hold that belief that it is still likely to do very well. It has done very well in the past, and we think the promise is still, a lot more ahead. And some of the top holdings are again there in front of you. Sectoral weightage, our pharma API, we've been very, very bullish for quite some time, as you must have heard us in our previous call, CDMO, pharma API. So that continues to remain very well. Capital goods, while everybody's saying capex cycle has not been happening, we've been bullish on this segment for last 3 years and have done very well, 3, 4 years, and we have done very well on this. IT, of course, we reduced our weight, and I'll talk about this little bit when we come to new trends, so that rather than talking it about right now and give you our perspective on that. Um, Rest all are, I think, probably normal weightages. Again, portfolio attributes are again well in place. I'm sure most of you have this, when you receive fact sheet, but they are just for your consumption out here as well. So, I mean, these are again a little bit of color on some of our portfolio, sort of contributors and all. Loras has done very well for us. And, Aditya Birla Capital has done well. Yatharth Hospital, again, I can tell you that, there was a time we bought it very early on when nobody was buying on listing. And there was a time when, and this is again a very, very important aspect to see. But there was a time when stock was down was at 550 or 600 rupees, and there was a broking house who wrote a very downgrade sell report, questioning a lot of governance related issues, and there was IT raid and all those things which happens in India, powerful courts. And that time, of course, we were a bit worried about it. Stock corrected almost 60-70%. But when we did our work, when we kind of understood the detail in the management, we spoke to management, we analyzed everything in detail, we found nothing wrong. I mean, income tax rates can happen, but so far nothing has been declared, nothing has been sort of, but we continue to remain invested. Today, the stock is back, and not only back, it's I think 750 plus, and has contributed very well to our portfolio. So I'm saying in investing journey, there are a lot of these kind of moments do come, which you have to sit, go through, live through, and that those are the kind of painful moments you got to live through. But rest all I think is pretty standard. With Paytm we bought. Again, I will talk about it. When you come to new trends, but we bought last, about 8, 9 months ago. It's done very well for us. Uh, Similarly, in the shift strategy, Lotus has contributed a lot. Hyundai has contributed a lot. So all those things are, I think, there in front of you to see. But each of these companies, have many of them have gone through the tough times. After bought, sometimes, our systems we saw, was down after we bought almost 40%, and then kind of recovered pretty much most of it. So all those things do happen, in investing journey. But some of all these companies are well researched, done very well. Um, in Amritkal, again, Hyundai is done well. Cryzek we recently bought at IPO. Again, a very good company. We think that in an education platform, very, very interesting company, which will, over a period of time, will scale and become a multi-bagger, we think. So these are, I think, again, most of the bottom-up pickup stock, which have contributed to our portfolio. Some of the detractors which are there, of course, and you cannot not have, so GSK Pharma right now is giving us pain, that's corrected, Indostar is corrected, BHL is corrected, but we are convinced about each of them. We think that, there's nothing wrong. Of course, we've seen almost, I think, 20-25% kind of correction in some of them, but they are all kind of, pretty well, doing well. Business wise, there is some technical cycle, cyclical stuff going on. Bharat Amritkal, SpiceJet we bought. We have had rough patch. We bought it around in QIP at 62 rupees. Stock has gone down to 32 rupees. It is a very big, of course, the hypothesis was that they had planes which are grounded, and for the want of money, they were not able to repair and fly. So the reason why all investors, so we put small amount, but a lot of market investors also put money in there, and the whole hypothesis was that you know there were money coming in, they will be able to fly planes quickly. But unfortunately, Boeing strike happened, and that part has got delayed, and some investors have panicked and sold the stock. Of course, this is the one thing which we have not liked. I don't know whether we monitor the situation on a quarter-on-quarter basis, but we want to wait for at least till March to see before, because large part of the damage is done. We want to see before March. We are not happy the way I think management has behaved in this whole period. This is, if you ask me, I don't know whether to call it. It was in some sense potentially investing mistake, but we have to live with it. We will keep revisiting. We will, but we think that large part of the damage is done, and as the planes are now getting ungrounded, and money should come and profit should come, but we will wait till March, to take any further call on this Q3 call and Q4 quarterly numbers before we kind of make any call. Though the weightage is very small, but it's not only about weightage. It's about, I think we take it's very seriously when we think that we have made. I think probably we misjudge the quality of the management here, or we ignore the quality of the management here. The business cycle turnaround was quite possible, but I think that is where partly it is accident, partly misjudgment. But yes, it is a very sore point in us when we evaluate ourselves in our own eyes. We look at this. And some of the new entrants are there. RBL, and we bought PNB. We were quite positive on the PSU bank space has done well. September, in fact, he has done much better. Maruti has done well. We were quite positive on the GST rate cut. So hence, and before that, post 15th August, we kind of bought it because we could see that this sector will benefit from there. RBL, it was more a tactical play, hence we exited. We made 60% return in 3 months' time, but hence we kind of played. It was a tactical play. We generally, most of you know that don't like small finance bank, small banks. Our large liking is not that. So hence, the moment we achieved our price objective, we exited. Reliance, nothing wrong. We didn't exit because there was anything wrong, but I think we needed to make some other buys, and to make space where we had high more conviction. Like, if how do I buy Maruti? Then so we kind of switched it because we could see the upside there. Hence we switched it because ultimately I have only 100 rupees. So that's where you do. And again, in shift strategy also, SP Apparel again down, negatively impacted by the tariffs because they have, and SRF again, we achieved quite objective. We made almost 30% return out there, and that was a large cap, and that was our kind of desired intended there. But more importantly, I think, we bought LTI and WPI, these two companies in the portfolio. Bharat Amritkal Fund again, partly I've touched upon. Some of the stocks we exited to make way for the ones which we wanted to buy, where we think there could be potential to make more money, and hence some of these exit entries are there. I only want to kind of highlight this too also very interestingly, that how our portfolio has done in last quarter, because a lot of things have been talked about. Again, earning for last 3-4 quarters. And in last one quarter, Q1 of FY26, Q2 is yet to come. This is again how our portfolio companies PAT and sales have grown, right? And you can very well clearly see that how it has done vis-a-vis the benchmark, that how companies, uh, uh, each of our strategies, PAT has grown very well. Again, except Contra, which I told you is our sore point, sore pain, and we are revisiting some of the stuff there. But across our portfolio, the growth has been far, far, far better than companies have resisted. And that again, I want to tell you that when we look at a lot of time, all the time, people are asking question, earnings are slowing down. So our job is to constantly keep on looking for when there are segments which might slow down, there are segments which will not. Our job is to identify businesses where we think still growth can come. Yeah, so this is here, and I'll again, will be happy to take questions later. But let me just first get to the market outlook. How do we think? Are we thinking about the market? And the elephant in room is, of course, tariff. Everybody's worried about tariff, and everybody's kind of thinking about what's happening out there. This is where again I want to see. If you remember last call, uh, I pointed out the fact that, I think we did on 15th April, post tariff that, what is the probability of, there are three scenarios that the US implement tariffs, will not, if it, will not implement tariff. If they implement tariff, India's tariff being lower than China and others, India's tariff being higher than China and others, and we have a challenge only if it is third category. And I said the probability of third happening is very low, almost negligible. And we ended up having that probability only turning around to the reality that India's tariffs are higher than most of the companies around. Right. So this is how situations can change. What you hypothesize may not play out. Environment is always fluid, and things can change the way you don't expect. So we saw the aggressive tariffs being levied by Trump. We saw deteriorating US and India relationship on all counts. And now obviously markets went down and then started coming to sanity to understand the real impact of it. What is the real impact, right? So you see, manufactured exports to US, as about $80 billion, and out of which I think about one third to 40% is exempt because of pharma, which they know that pharma US cannot levy tariff. If they levy, it is going to be there. And also, I want to say that here a lot of noise is being made about that it's a tariff on in India. Actually, it's not tariff on India. It's a tariff on US consumer. Let's say, assuming they go out with 50% tariff, none of the companies make 50% margins. So what they will do, even if they pass on the entire profits, still US consumer have to pay 30 to 35% tax extra. So, it's not happening. So, in my opinion, this is not sustainable. These are tactical, the negotiation tactics. We all know that our team is in US. Trump has made a lot of, overtures, and which is what we've been saying, that these are the, tactics. And this is again done one good thing. And again, I believe that every crisis is a good opportunity. And again, this has done one thing is, this led to fast forward the GST, reform. In my opinion, this has also created in government a little bit of more mindset open to open up the reforms so that our GDP growth does not slow down. Our investment cycle can accelerate, and based on whatever interaction we have had, government is working on a countermeasure plan, and which will increase the GDP growth. And at best, the impact could be 20, 30 basis point. If let's say US goes ahead with the implementation, you don't want it for sure. You don't like, the poor relationship with any country, especially US. But if this is what you have to dealt with, then you have to only think that what could be the implication. And only thing I can say that it does not change structural India story. India continues to remain very good story. Manufacturing also does not change, because in manufacturing, our import substitution itself is a very big opportunity. Export, of course, is, but import substitution is itself is $400 billion opportunity. As long as we focus on that, we are also sorted. And side by side, if of course export to rest of the country, world other than US, will continue. US also is not stopping. US might slow down if that they continue with that. So non-US exports continue the same path. In fact, if Ukraine Russia war settles down, you will see huge rebuilding exports opportunity also coming through there. So I believe that nothing is sort of structurally damaged because of this one particular situation. Of course, you don't want it, but if it is there, I don't think we need to get excessively worried, and that is our view on this. This I think partly I've covered. On the IT side, I think most people again, again through one more salvo in terms of H1 visa. Again, this thankfully they clarified that this is not on the new existing visa entry re-entry, so it does not make any impact on the current stock of the companies employees in US. Incrementally, of course, if they have to send those car costs also will be passed on, but more importantly, this will accelerate the offshoring, of the work here. And you know that post COVID, that offshoring part has gone up significantly. It only is margin accretive for the IT companies. It is not negative for IT companies. And more importantly, if it were to happen, let's say incrementally again 20, 30 basis point of impact on the margins of the companies would be there. That is the all thing, right? So it's not again a very big negative for Indian IT companies per se. Again, I this is another in a global context why we believe and we think that lot of let me first put lot of domestically what has happened and then I'll come to internationally. Domestically, if you see in last 6 to 8 months, 12 months, RBI reduced liquidity deficit from 3.5 lakh crores to probably potentially surplus of 3.5 lakh crores. RBI cut interest rate by 100 basis point. We had income tax cut last year budget. We have GST cut last year, this recently. All of these positives are there, which are basically because of this one worry of Trump tariff has got sort of, in my opinion, ignored or, and as an equity shareholder, all these are great booster or outcomes, but it's getting overclouded by the ongoing situation. Other thing, which we believe is that what is changing is in US steepening yield curve and, dollar getting, incrementally weaker. Both are very good trends for emerging market outperformance. And if you see historically, they have also played out. So we think that we are getting into a situation where EMs will do very well, and as a result of that, and even EMs will start receiving flows, which will have impact on our on our as we are all worried about FI outflow. So think about it. If FI outflow turns positive, combined with liquidity, domestic quote can happen. So we think that 26 calendar year would be a very good year from a FI flow perspective, partly reflecting by this chart. This I already talked about that RBI is basically infusing liquidity, and liquidity matters a lot both for corporate earning and in general functioning of economy. Uh, So again, Q1 estimated earning of, generally speaking, again, this I want to say, when everybody talking about corporate earnings slowing down, if you see Nifty 40, I mean, all the companies basically have reported by and large better than expectations. A lot of downgrades happened last year, last September, December quarter, but Q1 were results were better than expectation. I'm not saying better than expectation of 2 years ago, 12 months ago. But after downgrades, when people were expecting a very pessimist Q1, actually Q1 has turned out to be far more better than it was expected by the market. So we're beginning to see, and we think that you will see earning upgrade happening in the economy. If you again, this is a very interesting sort of how the if you see earning upgrades are within the company which are expected -10 to 5% kind of growth are going up, less than 10% earning growth are going down. So you are beginning to see earning cycle upgrade, consensus EPS changing. So you are already beginning to see, and we think that it's only going to accelerate in times to come. How analysts are, and the moment how investing community works is that as you see upgrade cycle, companies buy and stocks do well. Investors buy and stock do well. Very few people do end up buying contra. Very few people end up doing when things are sort of having the conviction when things are bad. So earning upgrade is something very, very significant possibility in times to come. And liquidity is all that DI flows are very, very robust. FI flows are, I mentioned my view about it that we think that 26 will be very good year. So backed by all these, facts, we think that markets are in very good place. A word on valuations. Again, last 12 months, markets have not gone anywhere. Earnings have progressed, as I showed you on the chart. So we are again a very reasonable range of valuation. We are 21 time one forward, 1 year forward. But if I were to take 2 year forward, we are almost 17, 18 times. So it's not a very expensive range given the kind of sustainable growth India has or India is expected to have. Uh, so, we continue to remain very, very bullish on markets while Nifty has been consolidating in a very narrow range. We think that it is setting a stage for an uptick. Even through the pessimist time, we kept on telling investors this is a time to sort of put in money. We are expecting good, credit growth in the banking financial services. We think that NIMs have bottomed out. Sectors which are likely to do well are consumer discretionary, automobiles, healthcare, CDMO, BFSI, and our portfolios are very much. If you look at our portfolio, they will communicate the very much similar view. Um, you know, Based by all these things, I think we remain quite positive. I think market probably will hit new high. We think that Nifty can go to 27, 28,000 in 6 to 8 months time, maybe before March or before budget. And but having said that, I always said that short-term volatility can come from any region, anytime. Like I said, that risk always comes from unknown sources and when it is unexpected. Uh, 6 months ago, I did not expect India will be the most disadvantaged country for tariffs, but today it is the reality. The only way you can handle this with prepare the quality of your portfolio, quality of your, and what gives me the most amount of comfort on India is our macro are repaired. And that is a very, very, and we have spoken in the past, but let me repeat, current account deficit. Historically, only five things brought us huge volatility, or five things brought us huge amount of downtrends or down markets. Whenever market corrected 30-40%, only because of these. One is current account deficit. Whenever it goes out of hand, India becomes vulnerable to currency shocks, our interest rate goes up, and economy suffers. But today our current account deficit got reported, got dropped from 4.5% to 0.2%. It came last week as a news item. So we don't need sort of foreign flows to sustain to pay our import bills. And to that extent, that's a repair which has happened. Historically, if US raised any interest rates, Indian currency and Indian interest rate will get impacted. This time around, US raised interest rates by 5% and our currency was and interest rates were holding on. That tells you about the kind of repair we had on CAD. Then fiscal deficit, again, we are one of the best managed fiscal deficits around the country, around the world. Um, and the reason why government could do GST is because we are very well fiscally well placed. Third is the banking system. Whenever banking system goes for NPA 10, 11%, our economy suffers. Today, our NPA are net 0.5%. Best in the world, best ever historically for India. So your banking is very, very solid. Inflation, whenever inflation goes out of hand, equity markets suffer. 2012, 13 were a classic example. Today, our inflation is well managed. We saw in around 3%. US is surprising on the upside. India is surprising on the downside. So very well controlled. And last, debt to GDP or corporate debt to GDP, very well in control, because that debt brings risk in the difficult times. So if we are not leveraged, how will we get much risk? So these are like vitals of our economy. There will be short-term attacks like vitals of our body. If the viral attack happens, right, we might be down with fever, but we will not be fatal or will not be in ICU. Same way, these kind of viral attacks, whether it is Operation Sindoor or tariff kind of viral attacks, will happen on Indian economy. But because our vitals are strong, we will not be down 30-40%. We will consolidate, we will stop our, we'll correct a little bit here and there. And that is the nature of the market. And because of this conviction in the fundamentals of the India, we remain fully convinced about when markets sort of panic, we remain very convinced and calm that long-term story is intact. And we think that growth will continue to supply and markets will continue to do well. So this is about our view on markets and our portfolios. But I think we keep hearing a lot of questions about few things. So I thought we will pick up and share our view on this one or two new trends which are happening. Very often, we hear and get questioned the IT sector. What do you think? H1B visa, AI is going to disrupt? And we said, let us first discuss what is our view on this. So, AI, of course, is a big risk, big change or disruption in the entire world, including IT services. But we think it's a very different perspective, and I'll share some of my perspective. See, IT services for India has three levers. Why we have done so well over constant technology disruption. That's a reality. The technology keeps on changing again and again and again very fast. We had Y2K, we had, then ERP implementation came, digitization came, cloud migration came, now AI. So constantly technology keeps on moving up, right? Or keeps on changing. And that creates a need for IT services. Aging population elsewhere, which requires the need for automation and efficiency, which again Indian IT services provide, and our market leadership. So one sector where we are leader by far. Nobody can challenge this. Almost 90% market share in the globally. Like China has in manufacturing, we have in IT. So these are the three constant reasons for our IT services to do well. And if you look at every time, there's a technology transition, it has only grown. The sector has only grown. I remember a lot of people wrote off, IT services for after Y2K. But let us not forget that time Indian IT services industry was about $10 billion. Today it is 200 plus billion dollar. So lots of changes happen. It is because of our, our strength. It has constantly sort of done very well. But every time there is change of the sort of technology or disruption or new technology comes, you will always see new players coming about. Like if you see in the, pre 2000, you saw all the, Infosys, Wipros, and Satyams, and DSQ Software. Many companies came and became big, right? Wipro was a very, very big start that point in time. But if you see 2009 to, post global financial crisis, when the, 2001 to 2007, 8 was a lull period for IT, but 8 to 10, after global financial crisis, new growth came. But in that growth, new companies became very big. Like, we did not have, LTTS, LTTI, Coforge, Persistent, Mindtree. HCL Tech was considered Mino then. It has become 17x. So what I'm saying is companies actually grow. TCS, by the way, till 2007, it was considered a dud company, laggard company. And if you see on post that from 2009 to 14, it did a fabulous job in terms of growth and has been leading the growth, became the largest IT company. So always readjustment of the companies happen in the sector. And that we also see, in my opinion. So what will happen, this time around? Now, traditionally, revenue growth was linked to headcount growth, but in last 5, 7, 10 years, IT companies have been moving towards from body shopping to outcome-based, solutions. So you go and provide solutions, and hence it is a gradual shift which has happening. Many IT companies or most of the IT companies have been moving towards that. Very small portion is only body shopping, right? Now you will use AI as a productive you know, productivity improvement tool. You can deliver the same services using AI, using uh, various new advanced tools. So delivery portions can change, but the need of IT services company for the organization will not go down. Think about it. If I am an organization, I need to evolve toward the new technology. Who will implement it? Who will do it? So you will need lot of tools could be there from taken from different sources. Like when the cloud migration was happening, all the IT companies use Azure and many other Microsoft products to do lift, shift, and implement into organization. If I am running a company, who's going to implement? Either I have to hire people in my own team, or I have to use experts which comes from outside and all, or a combination of them. So all I'm saying, in need of IT services is not going away. The industry is likely to grow. Yes, very often we confuse with headcounts and uh, you know uh, uh, so I think you might see, because they're able to bring efficiency, they are being able to use the advanced tools. You might see some sort of margin expansion for IT companies. That is what our view is. So these efficiency tools are actually helping IT companies and also creating demand. If you look at the order wins of all the IT companies, most of the IT companies has been very, very strong, right? So that's the point we are making. So new in this, as we transition towards the new technology, new companies will come, agile companies, smaller companies will scale fast, just like how Mindtree got created in that phase. HCL Talk scaled up, HCL Tech scaled up. Persistent, I remember, was a 1,500 crore market cap in 2013, 14. Today it is almost 70, 80,000 crore market cap, right? So new players will benefit a lot from every time there's a new technology disruption happen. And our job is, or our idea is, to keep looking for, rather than being just from a pessimist perspective, pessimist lens, we would see what this disruption brings as an opportunity. Of course, some of the large companies might get impacted, might not deliver returns as they delivered in the past, and we have to ignore that. We don't have to remain invested into them. But new opportunities will come, and our focus is to constantly look for some of those ideas and invest into either product company or focus on data, AI related technology, or company which are kind of in ER&D space. Those are the spaces we like in the currently in IT services. Second thing is, I think, I think most of you know this again, new tech, our view. In 2021, we had, when every new tech company was hitting the market, we had written a note saying fad, FOMO, fade, that the fad is going on, people are investing out of FOMO and it will fade away. And we never invested into that phase, and we told every investor not to buy, a stock in that, right? So we recognize that time that it was important sector, no doubt about it, right? that it will be important sector, but the risk reward of investment was not there, right? Because the way that time the game was that you don't know how to value. Every 3 months valuations were doubling, and only news in the market, newspaper used to come, Baidu valuation is doubling every 3 months, or every company's valuation doubling every 3 months. Nobody had any framework how to value these companies, and there was a herd mentality going on, and hence we avoided. And those companies were outpacing to incur losses. That more losses you incur, better valuation you get, and that was the narrative, and hence we avoided that. But since then, a lot of things have changed. Of course, market punished these excesses, valuations corrected sharply. Many of these managements have reworked their business model, focused on profitability or unit economics. Operating leverage started playing out. As because the growth continued, but with the growth, if you're not out, going growth for at any cost or at the cost of profitability. Earlier they were so as the volume comes and focus on efficiency, operating leverage kicked in, and more importantly, the free money went because at that time they were getting a lot of funding to burn money. As the funding dried for burning money, I think these companies had no choice but to kind of reorient, reform. So many of them have kind of changed that. Like I was saying during the that we bought Paytm when we got convinced at around I think 500 odd levels that it's a decent turnaround which is happening, and platform is very good. You can't rebuild Paytm ever, and it will require billions and billions and billions of dollars. Plus, more importantly, somebody has to take that risk to do it. So you can't rebuild that, and but as they are focusing on profitability, as the same thing happened in many other companies. So we have looked at some of them and invested. When companies like Urban Clap, which recently went public, you know, they went public at 15,000 crore IPO valuation, pretty much similar to where they raised capital at 2,000 2 years ago. So despite 2 years of progress, valuation did not. So companies are coming at a reasonable valuation. Again, not compared to traditional companies, but from new tech company perspective. And whenever they come at unreasonable valuation, we will not kind of tap into them. But the point I'm trying to tell you is that we have changed our lens from there because in the last 12 months, because the environment became, or we were been watching them very clearly, and because the environment, a lot of these things have changed. Hence, we've been looking at these companies in a focus way. So for us, what is the mode, how we are evaluating some of the new tech companies, that what is the business model? Is there operating leverage there? Are they replaceable? What kind of efficiency gain can come as they scale up? Is there operating leverage? Like to give an example, Urban Clap, why we bought it, because it's where once somebody uses it, the experience is so good that people use for different products. And today there's no competition to it. So it's a kind of without competition. Of course, stock did very well post listing, but you have to look at these kind of players from 8, 10 year perspective. They can, surprise you. And many of these companies will be like, as much as people don't believe, but many will be like, could be Amazons of the world. What happened in US, we are watching. I'm not passing any judgment which company will become what, but we will be watching that many these platform companies will become very large, and we will take appropriate exposure as right time comes. Considering our risk reward framework, I can only assure you that we will never compromise on our risk reward framework. Only we will take risk when we understand the risk. I'm not saying that once we understand the risk over there, we will take, otherwise we will not take. Finally, again, there will be all kind of periods in long wealth creation cycle. Last 1 year has been tough. Last 3 months have been good, but there will always be, pains. Long-term success depends on how investors behave in difficult times. Investing is a lot more behavioral than quantitative. You all know about it. All I'm saying, don't panic. While thankfully we have a set of investors, we have not received any panic call from investors. Thank you for that. I understand most of our investors are very, very sort of sensible. Increase allocation if you have surplus. If not, stay invested. Uh, Market always tests investors' resilience and patience. And my favorite saying of Rakesh Bhaiya, to enjoy a 10 bagger, you need to have a stomach to hold a stock while it halves, patience while it doubles, conviction while it doubles again, energy while it doubles again, courage while it doubles again. So identifying multi-bagger is easy, but real challenge is holding on to them. And I can only tell you that we have many 8 bagger, 10 bagger in our portfolio from the time we started, and we are still holding on to them. So we just believe that we want to be committed to our long-term wealth creation story. We do not want anybody who wants quick money to invest with us. And thankfully, thanks to all of you, you've been very, very patient. You've been very, very supportive, and you've been also very, very encouraging. Many or most of you are our, active brand ambassador. I know we get a lot of business through referrals, through word of mouth. So thank you very much for that.